What is tax harvesting and how to do tax harvesting? That's a topic for discussion today in the Market Secrets investment series. Before we head into the episode, I would like to mention a notification here. In addition to the investment series, we have multiple other series on price action trading, algo trading, and trading strategies running in parallel. Also, we have multiple data feeds being provided as part of our website. So if you are an active trader and if you are interested in any of it, do check out our website, which is www.marketsecrets.in, for the free learning and the services. And with that note, let's get into today's session, which is on tax harvesting. In this episode, we are going to stick to tax harvesting from LTCG in equities. So, what is LTCG? LTCG is nothing but long-term capital gains. These are the returns that you would make by selling your equity investment held for more than 12 months. So if you are holding any stocks or equity mutual funds and if you sell it after 12 months, then you will be having long-term capital gains. Currently, long-term capital gains from equity is taxed at 10%, but long-term capital gains up to 1 lakh rupees per year is currently tax-free, and anything above 1 lakh rupees is only taxed at 10%. Tax harvesting is a technique that is used to utilize this option. It utilizes the 1 lakh rupees annual LTCG exemption by selling and buying back part of your investment such that you realize the gains every year. This will reduce the tax you need to pay in the long run. So now, if you are a new investor or if you are just beginning your investment in mutual funds and stocks, your yearly gains may not cross 1 lakh rupees limit immediately. But when you let your profits run over for a few years, it will cross this threshold at some point. Similarly, people who have a large equity portfolio will have higher incremental gains. Therefore, if you want to pay low taxes or no taxes, then you need to ensure these gains don't build up beyond the tax-free limit. And that's what the tax harvesting is all about. So again, what is tax harvesting? Tax harvesting is a strategy of selling a part of your mutual fund units to book long-term capital gains and reinvesting the proceeds in the same mutual fund on the same day or the very next day. This way, you are not pulling out your capital because you are just reinvesting it, but you are booking your profits and taking advantage of the tax harvesting option that is available. So you are reducing your future tax outgo by using this option. So let's take a simple example to understand this better. Assume you have invested 2 lakh rupees in an equity mutual fund on January 1, 2021, and on January 5, 2022, the value of this investment has grown to 3 lakh rupees. So in 1 year, your capital had grown from 2 lakh rupees to 3 lakh rupees. Now, if you redeem this amount, your gains will be 1 lakh rupees and your tax liability will be zero. That's because any equity investments held for more than 12 months qualify for long-term capital gains, and the tax has to be paid only if the gains exceed the limit of 1 lakh rupees in a financial year. Next, if you invest this entire amount, that is just 3 lakh rupees, soon after redeeming, preferably on the same day or the next day, your investment cost will be reset to 3 lakh rupees along with the date of investment. Now, let's assume that your investment value increases to 3.8 lakh rupees after another year. When you redeem this 3.8 lakh rupees, your gains will be 80,000 rupees, which is still less than 1 lakh rupees limit under LTCG. So you don't have to pay any taxes next year as well. But for a moment, assume that you haven't redeemed this amount at all. So initially you invested 2 lakh rupees and now it had gone through 3.8 lakh rupees. So in this case, your long-term gains would have been 1.8 lakh rupees. And assuming that we are redeeming this particular amount in one shot after 2 years, your long-term capital gains in this case would be 1.8 lakh rupees. So 1 lakh rupees in the first year and 80,000 rupees profit in the next year. So totally 1.8 lakh rupees. And for this, you need to have to pay 10 percentage tax on the amount that exceeds 1 lakh rupees. So first 1 lakh will be completely tax free. For the remaining 80,000 rupees, you need to pay 10 percentage tax. So if you have redeemed this in one shot, you would have to pay 8,000 rupees as LTCG tax. But since we have done this tax harvesting, we have saved this 8,000 rupees in unnecessary taxes. This is the beauty of tax harvesting. You can use this method even when you are investing via SIPs or lump sums. You can redeem the units that you have held for more than 12 months and reinvest it to do the tax harvesting. However, if you redeem these units but if you don't reinvest, this strategy becomes meaningless because in this case, even your investment plans are going for a toss. So when you do the tax harvesting, invest the amount back immediately or as soon as possible. So what do you think about tax harvesting? Are you doing tax harvesting? If not, why? Every single person who is investing in the market should do tax harvesting because it reduces the taxes in your future years and it is not complicated at all. So if you look at the example here, this is exactly what is happening. So what you need to do is like you just have to redeem and reinvest on the same day. As simple as that. You don't have to overcomplicate it. So if you have any queries or issues with tax harvesting, please let us know in the comment section. I'll be happy to help. And with that, we have come to end of this episode. Hit the like button if you have liked this video and share it with your friends if you find it useful. Also, your feedback is important for us, so please do leave a feedback because that is what will motivate us to do more and better things for you. Also, subscribe to our YouTube channel and click the bell icon if you haven't done already. Thanks for watching. Have a great day. Goodbye.